Welcome to Share Views, brought to you by London South East. That's lse.co.uk. I'm joined by Mike Van Dulken, Head of Research at Accendo Markets. How are you today, Mike?
Very well, thank you.
Okay, we're speaking in the wake of sort of a bit of a retail focus to start off with. Better than expected June retail sales. You would have thought that people would be sitting in the garden rather than going to shopping malls, but they spent a bit of money.
Apparently not. Yeah, the good June weather has seen them spend a bit more on clothing. Some people are talking about whether the effects might be temporary. But if you look across the last few months or back to the turn of the year, it tends to see an up month, a down month, an up month, a down month. But the rebound from a weak May was stronger than expected. And of course that could, if it's not temporary, could stoke the fires of inflation that we've all been concerned about and which might have led the Bank of England to hike in August. Although, of course, just the other day we had the cooler than expected inflation figures. So mixed messages. What will happen? I'd probably see the hike being unlikely now in August. I'd probably need to see a few more months to be sure, because if the pound has strengthened quite a bit against the dollar, if that feeds through to less pricing pressure, it of course might put a cap on the inflation, which is good. Of course, any talk of a hike just strengthens the pound and reduces that inflationary. So, as I was saying earlier, the old World War phrase, talk cost hikes.
Right.
It's very easy now to talk it up, as of course we've seen from Mario Draghi. He's been the master of it over the years.
We'll see how he goes with that today. But we just wanted to focus on one of the stocks which is in the news at the moment, Sports Direct. Mike Ashley wants it to be the Selfridges of sports retailers, which sounds like an interesting concept. Possibly not quite the demographic that normally goes to Sports Direct. Shares up strongly, up sort of 7% back towards the 330 area. Interestingly, with Sports Direct, it was floated 10 years ago at £3. And so going into this, I would say in 10 years, it hasn't gone anywhere, which is amazing. Well, maybe not amazing if you know the character of Mike Ashley, but he's got in a new CFO, which sounds like a good move, doesn't it?
Yeah, I think the markets are reacting to welcoming somebody with, good pedigree, if you like, from Wincanton. So if you look at the share price chart, it's great. It's not the topsy-turvy journey that shareholders in Sports Direct will have had. Also, there's maybe people wondering whether a lot was already baked into the results in terms of it being a bad showing. We knew that they hadn't been hedging for sterling weakness. They acknowledged that was a huge hit to the full year results, and actually the outlook might be a bit more upbeat, looking for some decent revenue growth. So it may be a case of that was the worst is behind it, and the shares up almost 10%, I think.
I mean, as I hinted, the shares were back to where they were 10 years ago, and it's in 10 years that the company's done something.
There you go. There's support just waiting to be bounced from, perhaps, from the results.
Right. Another company which has been in focus clearly with the departure of the CEO is EasyJet. So the share's down now, and the market really wondering who's going to fill the void.
Yeah, I don't think the shares are down just on that. We had that news late last week into early this week. It's more the latest results are a bit weaker than expected, and I think the outlook, although the profits guidance has been increased, it would actually, I think, imply a weaker summer than many had been factoring in, which is not great because the summer is a key point of the year for someone like EasyJet in terms of people flying away for their week or two off. We've still got the uncertainty about Brexit, although it's made a positive move in terms of getting a license in Austria to allow it to run actually a separate airline, but of course it will allow it to carry on operations should we have a hard Brexit and leave that open skies agreement. So the shares are off strongly, but they had yet, I think, to challenge recent lows. So quite a big move for EasyJet, 5% down, but I think it hasn't weakened much more since.
Right. On the good news, we've got Unilever, which has been in focus. It was 5 months ago that the talks with Kraft Heinz hit the buffers, and the company's regrouping really since then. It's almost doing some of the work that Kraft probably was going to do too.
Yeah, exactly. Private equity are probably going to come in and shake things up quite considerably anyway. Obviously, Kraft is linked to 3G. So it decided not to go for Reckitt's food business. Some people thought that might have been a negative, but results today solid. Talking of focusing on margin increasing right through to a 20% margin by 2020. Markets like the sound of that. Good solid defensive play, nice dividend. People coming in, I think, today on the back of the results, good outlook, and seeing the shares off, maybe unnecessarily so, over the last little while.
Right, I mean the FTSE now is heading back towards the best levels of the year, let's say the 7,500 zone, driven by mining stocks and driven by positive China GDP figures, which were flagged, ironically, by President Xi, which is very nice of him to help everybody along there. In the case of Anglo American, I mean that's had its copper production figures out, 8% up. I mean, are you a believer in the miners again?
They've been, all of them are actually showing very nice bullish breakouts over the last, I think, 2 weeks or so, and they're just extending those. That's been helped by a good rally for both copper, iron ore. Then we had positive China trade data, positive China inflation data, and then positive China GDP. The flag from Prime Minister Xi to boost the story seems to be good. Markets like any excuse to run with a mining story on a positive China data, and the outlook is good. Copper benefits from potential strikes in Chile. That's been hampering Anto but benefiting others because it's obviously a price positive. And just generally the story seems to be cleaner across the miners, compared to the troughs they were in only a year ago. And of course this fuels hopes of a return for some of those dividends that have been absent for a good while now.
Right. The other thing is that U.S. markets hitting the highs, even though we've got no visibility on any of the Trump goodie bag, the Trumpflation and tax cuts, etc. Do you think that's sustainable?
Well, it's still, I think, tech driving it. Big talk overnight about we've got record closing highs, a trifecta, I think, on Wall Street. We've surpassed the dot-com boom. But the one difference this time is that the tech everyone's fascinated with now is not the same as the tech before. They actually have products, they've got revenues, they're making profits. So the valuations are much more reasonable. So there is an argument to say that they're not actually ridiculously overvalued, and that there's still legs to be had if the market wants to keep rallying. So we're in a different place to 17 years ago.
So Amazon and Facebook and Microsoft, solid situations?
It's not to say they're not facing competition issues, but if you're looking at them from a valuation basis and how much they've rallied since, it's not like we're talking the hundreds time PE ratios we had, if not even non-existent earnings 17 years ago. So there is potential for the momentum there to persist a while longer.
I've got Draghi speaking almost as we speak. You've got the trade now between, or the spread between the Eurozone and the UK, and obviously we're not really on the right side of that spread at the moment. The EU really, let's say, taking off since last summer, and the UK sideways at best. How do you think that's going to resolve?
Well, we're in a tough position because, I mean, much like you said with the US, visibility is rather lacking. Brexit negotiations are ongoing, but there's very little coming out of them that we can get our teeth into in terms of optimism. Draghi's facing that difficult situation where growth is doing well, so is unemployment, but inflation is still a bit tepid, all the while he's hinting at tapering. Now, we're nowhere near rate hikes, but tapering of the QE is a step towards policy normalisation. We've been here before with the US. It did lead to a bit of a tantrum, but markets seem to be taking this much better. Normally you'd have a bit of a lull in the market today before such a central bank update, but we've got breakouts across the board. DAX is above 12,500. The FTSE's I think it was 7,480, knocking on 7,500. We're just shy of record highs, and we're facing the prospect of tighter monetary policy. Markets seem to be getting used to the fact that policy is not going to stay as accommodative as it has been forever. So, okay, it's going to tighten, but it's still a very accommodative situation in relative terms.
Mike van Dulken, Head of Research at Accendo Markets, thank you very much. That's it for today's Share Views, brought to you by London South East, lse.co.uk.